Hey, this is Sasha Evdokov, and welcome to another episode of Let's Talk Stocks, episode number 145. And in this week's episode, what I'd like to do is scratch the surface about taxes when it comes to trading, investing in the stock market. Because what's going to happen is that for those profits that you're making in the stock market, whether they're from dividends, short-term, long-term profits, you're going to be taxed on those profits. And the way that the tax system is written is it's very complicated. And if you know some of the angles of where you can reduce those tax bills simply by trading a little bit differently, then by all means take advantage of those. Knowledge is power. And the more you know, the better you could set yourself up for the future, where your tax bill could save you 5%, 10%, 15% in the future from paying those additional taxes. Now, again, looking at a regular business, so if you compare a regular business like having a LLC S Corp or having a C Corp or just a sole proprietor business or an individual, you're going to be paying different tax brackets, and in different situations, you'll be paying more or less depending on how you structure and run your company, whether you're doing payrolls for yourself and those kinds of things. But it's all about knowing and understanding how much money you're making and how much money you're funneling in one area to another area. And just like going and donating things to charities allows you to deduct things from your taxes rather than throwing those items away. So it's important that you know and understand how the tax systems work within stock trading if you plan to trade stocks. Now, in this video, I'm just sharing with you the surface level stuff. I'm not an accountant. I'm not an expert when it comes to taxes. I haven't read the tax manual of the IRS code. These are just some insights that I've learned over the years, reading about stocks, learning about my own personal investments and finances through my accountant. So I'll just share with you some wisdom that I've seen over the years as far as taxes go for just active trading, from basic stock investing to dividends to also option trading, and I'll share with you some of those key insights in this video. The first thing you'll want to be aware of is dividends and how they are taxed. And dividends are taxed at 0%, 15%, or 20%. And this depends on the tax bracket that you fall into. So if you fall into the 10 to 15% tax bracket, your tax rate on dividends is 0. Now, you must include the dividend income with your other income for the purposes of determining your tax. And then if you fall into the 25 to 35% tax bracket, you'll be paying a 15% rate on your dividend, or a 15% tax. If you go ahead and fall above those, then you'll be paying the 20% on your dividends. So that's basically if you're in the 39.6% bracket. You'd be paying a lot more in taxes, just a 5% more if just for those dividends. Now, this is the way dividends are taxed, right? So it's a 15% is basically what most people will be paying. But if you're in the very high income bracket, then you'll be paying that 20% on dividends. The next thing that you want to be aware of is the long-term capital gains tax. And the long-term capital gains tax works, again, similar to the dividend basis. There's brackets. But here's the thing to really understand about long-term capital gains tax. Basically, if you hold a stock or an investment for a long period of time, this is why it's called a long-term capital gains tax, usually more than 365 days or 1 year, this is known as a long-term investment or a longer-term hold. If you're holding things for the long term, you get a tax break a lot less than you would if you held things for the shorter term. So say you hold a trade for 390 days or 450 days, and then you go ahead and you sell it and you take your profits. Now you're classified as a long-term capital gains tax. Whereas if you go ahead and hold it for a shorter time period, you'll be charged at the short-term capital gains tax rate. Now, this is the next thing that I want to cover, is the short-term capital gains tax. Now, the short-term capital gains tax is really when you're making trades. If you're a day trader, you're going to be paying short-term capital gains tax. And short-term capital gains tax is much higher than long-term capital gains tax. Again, it's going to depend on the bracket that you're in and the current year the tax year that we're in, because those things may change from year to year. So again, you may want to review those rates with your accountant and pick up the phone and see what they are currently, because if you're watching this video at some future date and time, they may have changed. But in either case, short-term capital gains tax at this point is charged a lot higher. And the reason for that is it's kind of, they look at it as not gambling income, but it's more active, right? So if you're more active in something and you're churning over money and financials, then you're going to be paying a higher income or higher tax on that income or profit and loss. So that's what happens with many people who are day traders, swing traders. If you're cranking out trades anytime that they're less than a year, you're going to get charged that short-term capital gains tax rate. And that's unfortunate, especially if you're really trying to move more into the full-time trading income side and you're trying to trade full-time. You're really going to be trading full-time and you're going to be charged that short-term capital gains tax. I know it sucks, but that's just the world that we live in. But if you're able to hold some of those trades out for a little bit longer and get that longer-term capital gains tax and fit into that bracket, it may save you that even if the stock is going down towards, let's say, your time frame, towards the end of the year or towards when you bought it last, then you may be able to hold on to it for just a little bit longer and then get out of it and take your little loss, because at least you'll go ahead and be in the long-term capital gains tax. So maybe you didn't make a $10,000 profit, maybe you only made a $9,000 profit, but you made up for it by holding on to that stock for just a few more days to be able to get into the longer-term capital gains tax bracket. Now keep in mind, when you're looking at the long-term capital gains tax, you're looking at the rate that you hold the trade. So it's the amount of time that you're holding on to the trade. So that could be from January 1st of 2018 to January 1st of 2019 or January 2nd. But it could also be from August to August, right? So it could be from the beginning of August 2018 to the end of August of 2019. So again, it's based on your hold time, not based on the calendar year. So that's what it's based on, is the amount of length of time that you're holding it for, because that's what's considered a longer term investment. Now, the way that you are taxed when it comes to your investments in your trading is that you're taxed based on your net gains. Okay, so this is your final net gain. And if you don't understand what a net gain is let's just say you made $50,000 on multiple trades. So you made $50,000 trading in and out of stocks. But then you also lost $20,000 on other trades. So your net, meaning take $50,000 minus $20,000, now you have $30,000. And that $30,000 is what you are taxed on. Okay, so it's the final difference. Whatever your profit is, that's what you're taxed on. Think of it like the income and expenses balance sheet, but it's not necessarily that exact way, which I'll share with you here in a second why. But it's the big difference between your total income and your total expenses or your losses. So your profits minus your losses, that's what you get taxed on when it comes to the IRS as far as investing goes. Now, there's a few little differences that go along with this if you're able to get classified as a professional trader. And this is what I was referring to. And this is based on the 429 rule of the 429 trader status, which can save you money. Now, the way that this rule works is a little bit differently. What it does is the best way I can explain it is when you have an LLC corp for a regular business, you're saving through payroll by funneling money into an entity, and then you go ahead and pay yourself a payroll. So that's kind of one way that you work a business. You're funneling money one way, and then you're going and paying yourself a wage. So you don't have to pay that Social Security and Medicaid or Medicare and those kinds of things. So you save some of that additional taxes that you would have to pay. Now, with this 429 trader status rule, you have to get classified as this first, and I'll share with you how that process goes in a second. But really what it does is it allows you to break things down as a trader. So now that you have a trader status rather than just a regular investor, it totally shifts the needle for you. It's difficult to get this status, but it allows you to now start deducting some additional things. So for example, now that if you go ahead and purchase one of my books or products, if you're classified as a professional trader, you can go ahead and deduct those as an expense. Normally, you wouldn't be able to do that because it doesn't fit along your business, right? It doesn't fit along your business of conducting and handling money. So you can't really deduct those things as far as educational material goes, from books, from seminars, hotels and lodging when you attend a seminar. Those things don't work because they don't apply. It's not ethical, it's not legal, that's not what you should be doing. But when you have trader status, if you attend a trading seminar or you buy a course of mine or you buy books, now you're deducting it. You're deducting it because you're running a business. And that's what this really does, is it allows you to classify this as a business. And also when you're classified as a business, well, now it allows you to get away from that additional Social Security and the Medicaid and Medicare tax that you'll be paying the additional fees on. There's a lot of other perks behind it. They're more subtle depending on the way that you're running the business, the way that you're trading. But those are some of the main big differences in that trader status, is that really you're saving a huge percent, around 14-15% on those additional Social Security taxes that you don't really have to pay. So in other words, it's the rich get richer through these tax breaks because they make the law so complicated that, if you're able to get through and you're able to get classified as a trader, you have enough money to trade actively, then you can go ahead and be classified as this if you are able to get qualified. And then you can save a boatload of money by not paying into, these government programs. So if we go ahead and visit the IRS website and we go to the topic 429, and let me just zoom in here for you. You can see that there's an investor section here, and then there's also a dealer section, but then there's also a trader classification section. Now you can go ahead and read through this rule, which may be a little bit more detailed than what I'm going to mention here, but you can see is that you must seek to profit from daily market movements in the prices of securities and not from dividends, interest, or capital appreciation. So you can see that for many regular investors who just profit off of dividends or interest or just appreciation is not going to classify you as an active trader. So you need to be making money from activity, from day-to-day activity. So your activity must be substantial. So what determines substantial? Again, they're going to judge this. It's going to really vary from whoever looks at your form at one point or another. And you must carry on with the activity with continuity and regularity. So you have to be probably doing it for quite a bit of time, and they like seeing those histories. So typical holding periods for securities are bought and sold. That's what they're going to look at: the frequency and dollar amount of your trades during the year, the extent of which you pursue the activity to produce income for a livelihood, and the amount of time you devote to the activity. So let's say you're spending 6 hours a day trading and then studying and researching, then you can maybe also get that as a little bonus or perk. So think about it as you get a little check mark for each one of these things, and then the more check marks that you get, the better off you are, kind of like a point system. So again, you can continue reading through this, but there's a lot of additional benefits that go with this beyond just doing the deductions for trading education. It really comes down to saving also on Social Security and Medicare taxes that have to be paid on those incomes. In that case, you can also set up some special retirement accounts that are also more tax friendly. Again, it's really all about knowing the right accountants that are going to do this setup. But the first things first is you really would have to be classified as a trader here by the IRS. And sometimes it's not really favorable for you to do this. In certain situations, it may actually be not as beneficial depending on your personal situation. So it's important really to recognize how you like to trade first, and then see if you can kind of get that classification, if it would actually benefit you. One of the things or insights, for example, is if you're actually looking to deduct like books, educational material, that kind of stuff, and you're really spending a lot of money on seminars and things like that, well, I mean, if you had a personal growth, or let's just say a personal finance coaching business that you started, well, by all means, you can probably deduct some of that education because you're learning more about investments, you're learning more about books, and now you start getting into that gray area, which again, depending on which business you start, whether it's personal growth, whether it's finance, now it starts to get more under that umbrella of hey, this is actually being used for your business and not just trading or investing. So again, you're still attaining the knowledge, you're still attaining the information or you're going and attending into these trading seminars and trading events, but you can deduct them because you still have a business that's also, for your personal growth business or a personal finance business or a financial coaching and consulting business. So again, look at it from that standpoint, but get some insight from your accountant depending on your own personal tax situation, because I don't know which situation you're in. I'm not an accountant. I'm not an expert in these kinds of things. I'm just giving you some insights and areas that you can go out and do some more research, give you some insights of directions that you can attack and go ahead and make things work for you. Now, one other thing you need to keep in mind is the wash sale rule. And the wash sale rule can hurt you as far as taxes go, or tax-wise. So what the wash sale rule basically states is that if you're taking a loss in a certain stock, let's just say you got into a stock at $40 and you went ahead and took a loss at $30. So now you took that $10 a share loss, and you can go ahead and deduct that from your taxes and so forth. But if you get back into that trade, let's just say at $32 or $33, less than 30 days from when you closed it, all of a sudden it negates that loss that you had earlier. So this is kind of the wash sale. So it just kind of forces people to not just take a loss in order to reduce their taxes right away and getting back into trades, because there's a lot of ways that you can manipulate those kinds of things by taking a loss in certain stocks and getting back into them. And the IRS didn't want you to take advantage of those deductions and just constantly accumulate loss after loss after loss to reduce those taxes. So that way you basically had no income whatsoever. Now, some people do this in a really funky and weird way from the stories I've heard. Now, again, I don't think this is legal, so but what they will do is have multiple brokers, and when they go in on one account or one broker, they go ahead and buy shares and they buy the stock, and then another broker, they're going ahead and taking losses on those shares. They're just going in the other direction, and they'll take the loss. Now, I'm not exactly sure how they play and manipulate the system, but I know that they're trying to work their way on these losses and work through that. So again, there's a lot of weird, fishy things as you get deeper into understanding the tax rule, that the way things work. And again, I'm not advising you do this. I'm pretty sure it's illegal, but just understand that things can get very, very problematic for you if you're really trying to avoid your taxes. So again, talk to your financial accountant, talk to your financial planner about all these things. But understand that as far as taxes go, you don't want to go ahead and sell a stock and take a loss in it and get back in it within 10 days or 5 days trying to go ahead and make up those gains, because you're going to actually hurt yourself from being able to deduct that from your losses. Now, if you're an option trader, options are taxed the same as stocks. Of course, you're not going to be getting option dividends. But if you're looking at short-term versus long-term capital gains tax, it's the same thing, because you can buy options 3 months out, you can buy options 6 months out, or you can sell them 3 months out, 6 months out. And you can do the same thing for leaps. So options that are longer term, that are 300 days, 600 days out, they can also work in the same way. So they're taxed in the same manner as the stocks are. Now, there's one major and big advantage, though, when it comes to options, and that is the 1256 contract rule, which can help index options traders. So if you've never heard of this rule, what it allows you to do is get in and out of these index options very quickly, and allow you to take only 40% is short-term capital gains tax. And then 60% is long-term capital gains tax. So take, for example, a $1,000 profit on the SPX. Okay, so 40% of that profit, right? You made $1,000 profit. 40% of that, call it $400, is going to be taxed at the short-term capital gains tax. And 60% of that, $600, is going to be taxed at the long-term capital gains tax. So it allows you to save a few percentage points on your taxes, because you got almost more than half at the long-term capital gains tax simply by trading index options. Again, a little weird rule that allows you, the rich folks or people who have money or trading index options that understand the tax code, invest in their education, to slip by. And ultimately, I really hate the way that the IRS structures these things. They make it very complicated to where you really got to know people. You got to pay people to understand what's going on and how best to trade to maximize and save money on your taxes. It's really all convoluted, but they're trying to make up rules for different situations and so forth. But here, if you're trading index options like the SPX, you're trading the NDX, you're trading the RUT, these are all index options. If you're trading the SPY, the IWM, or the QQQ, those are ETFs, and those would not be considered index options. They would be more tax-like, depending on if you're doing options on them. Again, short-term or long-term capital gains tax, at least from my understanding. But you got to be trading the SPX or the RUT or the NDX, those kinds of things, where they're actually indexes, to be able to classify it as a 1256 contract rule. And if you want to get more insight on it, you can read more on the Wikipedia or the IRS website. Of course, I would definitely recommend you talk to your accountant, but you can see that the IRS is not clear on whether QQQ, Diamonds, and SPI should be treated as 1256. So again, I don't think they are. So in order to avoid those things, better to trade the SPX and the RUT or the NDX, those kinds of options, because they're an index based. That's what you really want to go for. You could also trade the VIX or the VIX. That's also an index option that you could trade and take advantage of the 1256 contract rule. But you can see here that there's a great deal that you can save, 40% short-term gains and 60% long-term capital gains tax. And that's because you're trading these future contracts, and it makes things a lot better when it comes to these index options. It saves you about probably 10 to 12% on your taxes, depending how much trading you do, but it does save you a great deal of money if you understand how this really works in the marketplace. All right, so again, final disclaimer about these taxes and these tax rules and implications. What I wanted to do was just share with you some insight about what I've learned over the years and things I've heard, and the ways that I've dealt with in business as far as the accounting side goes, what I've researched, and just some of the things I've overheard other people doing and trying to manipulate the system. Ultimately, this is what I see taxes being done as, is whoever knows more, they're going to pay less taxes. So if you know more about them, you'll pay less taxes. Sometimes it's worth it to go ahead and pay an accountant $200, $300 for an hour or two of their time to go in detail about over all these different rules and situations, depending on the type of trading you do. Remember, it's based on the type of trading that you do. So don't email me and ask me what's better for your situation. I don't know your personal situation. I don't know which tax bracket you fall into. I don't know the other things that are going on in your life. So that's why it's best to contact an accountant that can spend a couple of hours with you diagnosing your personal situation. And then you can get some insight on, where it's best for you to invest in, or how it's best on a tax basis. Now, don't look at just taxes as far as investing goes. Normally what I say is stop worrying about taxes. Instead, for me, I always look at, I want to pay more in taxes, because the more that I pay, the more I'm making. If you have that kind of tax mentality, you're going to be more profitable in the long run. But many people, they actually change the way that they trade based on the taxes that they're going to pay. And if you do that, you might actually be trading in ways that you don't like, in ways that doesn't fit your trading style or your risk style or your personal goals. So don't focus on the taxes. Instead, understand the taxes to where maybe you can adjust your trading a little bit and save on the taxes in the long run, but get some insight from the accountant, get some insight from somebody who understands the tax rules and the tax codes, and then tweak your trading a little bit, but don't completely change it and, just focusing on trying to reduce your tax bill, because that's just going to hurt your trading if you're not trading properly, if you're not trading in ways that's profitable for you, because some people fit a little more on a day trading basis and they're very active and they're trading 6-8 times a day, for 6 hours at a time, and they're investing a lot in their education, and they could be classified as the 429 trader and get that classification, and it might be beneficial for them. For other people, if you just like trading index options, then by all means do it that way, and you don't need the 429 trader status, because you're doing things a little bit differently and you're saving it over there. And is it worth the extra headache? Again, maybe, maybe not. Just depends. So talk to your accountant, Don't reach out to me and ask me questions about it because I'm not an expert on the tax situations. They make those rules and laws just so complicated that you really have to be a lawyer, and I'm not a lawyer. I just did go ahead and do my research, my due diligence, and share it with you. That was my whole goal and purpose behind this video, is just share with you some knowledge and insight so that way you can go ahead and start learning and taking things deeper down one road or another. So thank you for sticking with me in this video. Hope you enjoyed the lesson. And if you did and you want to see some other great training videos, then visit my website at TRADERSFLY.com. Now, if you want to get some in-depth knowledge in my video courses, then visit RiseToLearn.com because that's where I have all my video courses listed. And don't forget to join me on a live webinar and class, clicking this button right here, getting on the newsletter list, and that's where I send out all the details. In the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. And I'll see you next time.